So today, Scholar, we are going to talk about chapter 3, the adjusting process. We're going to talk about, in the previous chapter, we have talked about journal entries, how we, uh, record things and how we're going to report things. So this is a process in which we are going to see how we're going to correct our journal entries and how we're going to post these things into into ledger, and then from here to create a trial balance and eventually preparing financial statements. So let's talk about first with the basis of accounting. So the basis of accounting refers methodology under which revenues and expenses are recognized in the financial statement of a business. So there are two bases of accounting. One is called accrual and the other is called cash basis. There are two other bases of accounting. Just want to let you know for your interest. One is called tax basis of accounting. Tax basis of accounting, and the other one is called regulatory basis of accounting. You're going to study cash accounting here in this course and maybe a couple of places in another course, but majority of your accounting will be done throughout, if you become an accountant, will be accrual basis of accounting that is based on GAAP. The tax basis of accounting and regulatory basis of accounting, you're most likely to learn when you get a job as an accountant, if the company that you work either use tax basis of accounting or if they are using regulatory basis of accounting. So regulatory basis of accounting, you probably will be looking if you work for a company such as railroad companies or insurance companies. Tax basis of accounting, it's a hybrid between accrual and cash, and you will learn most likely in a mid-level company, mid-sized company. So we are going to focus here between accrual and cash, but our focus throughout the semester will be GAAP basis, accrual basis of accounting based on GAAP rules. When an organization refers to the basis of accounting, that it uses two primary methodologies are most likely to be mentioned. One is the cash basis of accounting. It is very, very simple. All or most small businesses use this basis of accounting. Revenue is recognizes revenue when cash is received, and expenses when bills are paid. So we recognize revenue when cash is received, and we recognize expense when bills are paid. So it is very, very simple. Again, revenues are recorded when cash is received and expenses are recorded when cash is not allowed under GAAP. Easier method to follow, requires less knowledge of accounting, concepts and principle. Basically, we don't use much GAAP here in the cash basis of accounting. Accrual basis of accounting is required by GAAP, especially if you are a publicly traded company or you want to be in future a publicly traded company. Requires company to measure and report accounting transactions without the necessity that cash has been received or paid. Means GAAP accounting or GAAP rules or accrual basis of accounting does not bother whether you receive cash or not. It talks about whether revenue has been earned or expenses has been incurred. That's the most important thing when it comes to required by GAAP. Accrual accounting transactions such as collections, cash from customers, receiving cash from interest earned, paying salaries, borrowing money, paying off land, loans, and issuing stock. So accrual accounting records transactions such as collection from cash. What does it mean by collection from cash? So when you are selling something on credit, basically your customer is not paying today, they will pay you at a later date. What you have, you do not have a cash, you have what we call account receivable. So we debit account receivable and we credit revenue. Why we do that? What we are saying by crediting revenue, I have provided my customer the service or the product. Now the customer is giving me a promise, an account receivable. It's a promise I have from a customer that the customer will pay me back in 1 week, 2 weeks, 1 month, or a quarter. So this is a claim a business has on their customer and is called account receivable. Claim business have on their customer. All right. Receiving cash from interest earned, same thing. And paying salaries, rent, and other expenses, borrowing money, all of those things. But this is cash. So what happens when you have this? So this is the first step. And the second thing is going to happen, you're going to receive a cash. So when you're going to receive a cash, you're going to say debit cash, and you're going to credit account receivable. Why you're crediting account receivable? You are saying, I do not have a claim on the customer anymore because I received the cash. So these two things, we need to remember this. Okay, let's continue. Based on the following principle, we're going to talk about two very important principles. One is called revenue recognition and expense recognition, the matching. Always remember, revenue follows expenses. Revenue follows expenses. Time period concept. Accounting information is reported at regular interval. We talk about the word period, and the time period is the same thing. It's basically the intervals here means month, quarter, or a year. This is monthly, quarterly, and yearly reporting is majority of our businesses followed. Basic accounting period is 1 year. That is true because majority of their businesses issue their financial statement every year, but publicly traded companies also issue quarterly statement, and they do prepare monthly statements to provide quarterly report, and they prepare quarterly reports to provide yearly reports. Around 60% of large company uses calendar year from one. A fiscal year is an accounting year of any 12 consecutive months that may or may not coincide with the calendar year. Example, Walmart. Walmart year starts on February 1 and ends on January 31st. Okay. So majority of the companies, like says, use calendar year, means from January 1st to December 31st. But there are other companies who uses fiscal year, and that is a 12 consecutive month. For example, Walmart uses February 1st to December 31st. And we're talking about interim periods. It's basically we're talking about quarterly, monthly, semi-annual, or on demand, like your boss says, I want the last 8 months of sales revenue or last 8 months of income statement. So it could be on demand. So now we're going to go to revenue recognition process. It's very important. Make sure you understand this principle, because this will help you throughout this course and in future in accounting as a student and accounting as a professional. And not only that, if you don't become an accountant, you just go into management, would be the most of the important thing that you would be dealing throughout your career. So revenue recognition principle is the most important. Please pay attention. It accountants that when to record revenue and requires companies to following the 5 step. When to record revenue, and also I would like to add how much we're going to, how much. When to record revenue, when means a date, and how much means the dollar, how many dollars we're going to recognize. Identify the contract with the customer. What is a contract? A contract is an agreement. It could be an oral agreement or it could be a written agreement between two parties. One is the seller, other is the buyer. So the customer here is the buyer. Identify the contract with the customer. The seller and customer both needs to identify that contract. A contract is an agreement between two or more parties that create enforceable rights and obligations. Right? Rights and obligations for both parties, for both seller, buyer, and sellers. Both two or more parties, so we're talking about buyer and seller. Identify the performance obligation in the contract. What is performance obligation? For example, you have asked me to make a custom made chair and a table, a dining table. So my responsibility is to provide you the dining table according to the specification that you have given me. It includes size, it includes color, it includes what kind of wood I am going to use, what kind of cushioning we need, what kind of polish or finishing we need. So that is my responsibility, my performance obligation, to provide you the dining table with chairs and everything according to the specification you have provided me in writing or maybe verbally. Your performance obligation is that you have to pay me for that. So for example, our contract spells out that you as a customer will pay me 25% of the cost upfront before I start working on it. Once I, substantially completed the project, let's say I have cut all the wood and everything and about to assemble, you would have to pay me another 25%. Once the assembly is completed, you pay me another 25%. And then when I will deliver you the finished product, you will pay me the another 50%. This is just an example. So your obligation as a customer is to pay me 25% at the time of signing this contract. But for me, it is not a revenue because I haven't provided you the dining table. So I will recognize the entire revenue when I will give you your table and you accept that table. Until that, I'm obligated to provide the way the things are. Okay. So a performance obligation is a contractual promise with a customer to transfer a distinct good or service. We have already done that. Determine the transaction price. So let's talk about how much we're going to charge for this dining table. Say the price is $2,500. So I'm going to make a dining table with 12 chairs, big dining table, $2,500. Okay. This transaction price has to be agreed by the buyer, the customer, as well as the seller. The transaction price is the amount that exactly expects to be entitled to as a result of transferring good or service to the customer. Okay. The next step, allocate the transaction price to the performance obligation. Like I said, we divide this in 4. You pay me 25% when I sign the contract with you, 25% when everything is ready to be assembled, then 25% once I assembled everything, and the 25% when I deliver it, or other way, any If the transaction has multiple performance obligations, the transaction price will need to be allocated among different performance obligations. Like we can do it in the 4 steps, for example. Recognize revenue when or as the entity satisfied each performance obligation. Either we can recognize a revenue at each step, or we can recognize a revenue at the end when the delivery is made according to your specification. A good or service is considered transfer when the customer obtains control of the good or service. So when I am going to give you the table, you look at it, you say, yes, it is according to my specification, accept it. At that moment, I can recognize all the revenue, $2,500. The amount of revenue recognized is the amount allocated to this satisfied product performance obligation. So we have made 4 steps, right? 25% each. Either we can recognize at each step this revenue, or we recognize revenue at the end. Majority, almost all of your questions will not ask you, whether it's a homework quiz or exam question, will not ask you to do it in 4 or 5 steps. It will ask you to do questions at a 100% all the time. Expense recognition or matching principle. The matching principle guides accountant for expense and ensures expense incurred to generate revenue are recognized or matched in the same time period. For example, you get the order for this bill on February 15. You make a delivery on February 28. Customer accepted. All this revenue belongs to the month of February and belongs to first quarter, because the first quarter has January, February, and March. And if you want to be more specific, this revenue belongs to 2023 as a year. So it belongs to the month of February, it belongs to the first quarter, and it belongs to the year 2023. We cannot, and we also have to recognize all the expenses, the wood we purchased, the labor, all the related items that we have used to complete this will be recognized in the month of February, because the revenue belongs to February, the expenses belongs to February. It does not matter whether you have already paid for these expenses, you are paying during February, or whether you are paying in the future, but they will be part of the month of February. As with revenue, cash payment may occur at the same time before or after the expense. Okay. All expenses are recorded when they are incurred. Incurred means used up during the period. Expenses are matched against the revenue of the period. Why do we want to match? Because in the income statement, we want to make sure the revenue that we are talking about, that we have made by providing either the service or product, match with the expense, so we can say that how much profit that we have earned. For example, I am earning $2,000 in revenue, my expense is $500. So I know that in this transaction, or in this month, or in this quarter, or in this year, my profit is $1,500, and I know that in order to make $1,000 revenue, my expenses would be around $500. What are the adjusting entries and how do we record them? An unadjusted trial balance, we talked about last time, lists the revenue and expenses, but these accounts are incomplete because they omit various revenues and expense transactions. And the end of the process begin with the trial balance. So first we make a trial balance, and that trial balance is unadjusted if debits are not credited to equal, and then we have to use various rules to find out what we are missing, and then we find that missing information, and then it becomes an adjusted trial balance, and we use adjusting entries. So what are those adjusting entries? We're going to talk about these things. Adjusting entries also update asset and liability accounts. Two basic categories for adjustments are deferrals and accruals. Defer the recognition of revenue or expense to a date after the cash is received or paid. Two types of deferrals. Deferred expenses. Deferred expenses are advance payment of future expenses, also called prepaid expense. So let's do an example. Example here is, let's go on the next page. Today is date is say August 1st, 2023, and the business is purchasing insurance. The price of or cost of insurance that you are paying is $1,200, and it coverage of insurance is from August 1, 2023 to July 31st, 2024. All right. Now, so what is a per month cost of insurance? Per month cost of insurance is $1,200. And how many months from August 1st to December 31st? 12. So it's going to be $100 per month. All right, very good. So when you purchase this, the journal entry on the date of purchase which is August 1st, so we put August 1st, 2023, we're going to debit prepaid insurance for $1,200, and we're going to credit cash for $1,200. What we are saying? We are saying that I have purchased insurance, auto insurance, for my company truck for $1,200, and I have paid cash $1,200. So the company or the business is $1,200 down in cash, but they have also purchased $1,200 worth of insurance to cover the next 12 months of the auto insurance or for the truck of the company. All right. Now we are going to talk about adjustment. Adjustment is usually happening when you are making a quarterly statement, monthly statements, and yearly statements. So suppose we are on December 31st, 2024. So this is the date and December 31st. How many months have passed? So the entire month of August, September, October, November, and December. So 5 months have passed, right? So how much insurance you have used? 5 multiplied by 100. So you have used $500 worth of auto insurance is used up. All right. So I'm going to show you another thing over here. There is a T account for prepaid insurance. Here is a debit and here is a credit. We know that prepaid insurance is an asset, so it will go on this side, $1,200. And this is what we did on August 1st. But now we are on December 31st. We have already used $500 of insurance for 5 months. So how much we left? We left with $700 for the next 7 months. So this is how we going to put this $500. We going to do this. We're going to say debit insurance expense for $500, and we're going to credit prepaid insurance for $500. What we are saying that my asset, prepaid insurance, is down by $500 and my insurance expense is $500. I want you to remember another thing. When an asset is used up, it becomes an expense. Believe I talked about this in last lecture as well. So when an asset, so prepaid insurance is an asset. It's used up, now it's become an expense. Okay, so it's moving. So asset stays on the balance sheet, expense stays on the income statement. So the information is moving from the asset, from the balance sheet to the income statement. If we do not do this thing, our income statement will be incorrect or underreported by $500. So that is the reason we are doing this. Okay, let's talk about so recognize as an expense by adjusting journal entry. These are the things. So in your homework or quizzes, this is important because the question that I have done, this one and all those 4 topics will be in your, so instead of prepaid insurance, you can use prepaid rent or office supplies or depreciation or deferred revenue. We're going to talk about in a minute. Okay. The next thing we're going to talk about is prepaid expenses. I have already given you an example of insurance. Now we're going to talk about the second one I'm going to talk about is unearned revenue. So here is an example of an unearned revenue. Suppose a customer walks in and places an order for dining table. He agrees to pay $5,000 for dining table, and he demands that the table should be delivered on September 20th, 2023. And today is today's date walks in on August 23rd, 2023. All right. Customer paid $5,000 on August 23, 2023. Now, if a business has received, what business has to do is to say debit cash. We have received cash of $5,000, but because we are selling, so it should be a revenue, but you have not provided the table yet, so we will call it unearned revenue for $5,000. And unearned revenue is a liability, right? So you just made this 8/23/2023 a journal entry that the business has received cash. Now comes September 20, 2023, you deliver the table to the customer. Customer likes the table and he says, thank you very much. The customer does not have to pay you anything, but what you're going to do, you have to make a journal entry and say debit unearned revenue for $5,000 and credit sales revenue for 5,000. So today you are recognizing the revenue because you have earned the revenue. So when we do this, there are two T accounts here impacted. One is the cash, the other is unearned revenue. You know that debit is always on the left, credit is always on the right, debit on the left, credit on the right. You receive the cash, which is an asset, so it's going up $5,000. Unearned revenue, as I said, is a liability. Liability is going up by $5,000. You credited. But what happened on this date? You have two accounts. One is the sales revenue and unearned revenue. So we're going to use it over here. So we're going to debit the unearned revenue, that zero out the account, which says I do not owe anything to the customer because he has accepted my table as I have prepared according to the specification he provided, and your sales revenue will become $5,000. So it's basically transferring from unearned revenue to a sales revenue of $5,000. So this is an example of deferred revenue and how when it's earned it becomes a. So remember one thing, unearned revenue is a liability, and a sales revenue is recognized once you provided the product to the customer. Okay, let's move to the next thing. Accrued expenses, recording operating expenses that have not yet been paid or recorded. So accrued expenses are the expenses that you have already used it, but you have not recorded or paid or recorded yet. So what are the examples of accrued expenses? Let me use this over here. So accrued expenses. Received a phone bill for $100 and the duration was for the last month, for the month of July in August. So in the month of July, whatever you have used a phone, it cost you $100. So you haven't paid it. So what you're going to record. So on, say you received on today's August 23rd, 2023, you're going to recognize that debit utility expense, or you want to be more precise, you just say or phone bill if you want to do this for $100, right? And you're going to credit phone bill payable or accounts payable, whatever you want to use, $100. So what you are saying here, yes, I acknowledge that I have used the phone service provided by the phone company in the month of July, and they have sent me $100 bill. I recognize both. However, I don't have the money to pay right now. I will pay you some other time in the future, next week, next year. So I am recognizing by saying it's a payable that I'm recognizing it is my liability. It is a liability of a business to pay at some point in future this $100 to the phone company. So this is an example of accrued expense. Okay. The next thing is accrued revenue, recording revenue that has been earned but not yet been received or recorded. So let me give you an example. Debit account receivable for $500, credit sales revenue for $500. Why? What we are saying is the customer did not pay me the cash on August 23rd, 2023, because he does not have cash or he does not want to pay the cash or whatever the reason. But I have provided him everything he wants and he owes me $500. And that's what we're acknowledging in this journal entry by saying debit account receivable is a claim that business has on their customers. Suppose on 9 September 15, 2023, the customer show up and say, hey, here is your $500. What are you receiving? Debit cash for $500, and you are crediting account receivable for $500. What you're saying, yes, I have received $500 from my customer, and yes, I do not have any more this claim on this particular customer for $500. This is what we are saying in these two journal entries. Okay. So what are accruals? Record on expense before the cash is paid, or records revenue before the cash is received. That's it. Two types of accruals: accrued expenses and accrued revenues. Accrued expenses are expenses a business has incurred but not yet paid. It could be salary expense, interest, and utility. The salary expense will be asked in the exam, including with interest and the utilities, but these two are more often repeat, and this salary expense may show up in the later chapters as well, interest expense as well. So the one thing we're going to talk about is depreciation. What is depreciation? And one more thing about depreciation. We are talking about depreciation in this chapter, and there will be another chapter we're going to talk in more detail. So this is just an introduction because it is an important topic. And of course, all of those things that we are discussing, you will be seeing in the accounting cycle project, you will be seeing in the homework, quizzes, and exams. So what is depreciation? So the idea behind depreciation is when you purchase, you means a business, purchase a asset that has a life of more than 1 year, which we call it a long-lived asset, long-term assets. These assets over a period of time loses their value because of use, because of wear and tear, and for any reasons. So what we are talking about, we're talking about furniture, this table. We're talking about this computer, the Ambra, and all those things. We're talking about automobiles. We are talking about buildings. We are talking about furniture. We're talking about fixtures. All of those things are depreciable. The only asset that never depreciated is the land. And there may be a question in the exam you may have to face, so make sure you know this, that land never depreciated. All right, so all of those are get depreciated. Now how so that's one reason for that these things happen. But why do we depreciate? Depreciation is an expense. So for example, you purchase a computer for $500,000. You paid everything at the time of purchase. So you bring home, also bring to the business, you say debit computer system for $500,000, and you credit. So you say debit computer system, I'm just saying CS 500,000, and you credit cash for 500,000. Now you are going to use this computer over its life. So what is the life of a computer? Well, only thing I know that it's $500,000. That's what we paid. And so why we are recording at $500,000? Because historical cost principle dictates when we purchase asset or asset, it has to be reported on the price that we have paid, right? And obviously we're going to add some more to it in later chapters. So right now you just need to know that we are using historical cost principle to record the purchase of the computer system for $500,000. Now we're going to call the computer system people and say, hey, we're going to use this computer system. Now, what do you think? How long is going to last? Suppose they say it's going to last for 10 years. Very good. That 10 year is an estimate that is coming from the computer vendor, and we accepted it. Then we have to find the second question we have to deal is, what would be the value of this computer system after 10 years? And they told, well, after 10 years, it will be junk, means its value is 0. Okay, so that will give us the information to calculate how much depreciation expense we can claim every year. So let's talk about it. The allocation of plant assets cost over its lifetime is called depreciation. We know that. Adjusting entry records cost allocation of depreciation expense. Now, why we are doing depreciation expense? We are doing because this computer system is helping the business to generate future revenues. Because this helping us generate future revenue, we know that we have to match our revenues and expenses. So we have to find out how much expenses we have incurred as a business in order to produce this revenue. So for example, if this company using this computer system and many other things generate $1 million of revenue in a year. So they know that in order to generate that $1 million revenue, this computer system also provide or help us do it. So we have to take that depreciation expense in order to find out exactly what was the profit of the company by deducting that expense from the revenue. All right. The expected value of a depreciable asset at the end of its useful life is called residual value, and we know that in our example is 0. We use the straight line method. There are other methods which we'll discuss in later chapters. Allocates an equal amount of depreciation each year is calculated as this. So in our case, our depreciation expense would be 500,000 minus 0 divided by 10 year. That will be $50,000 per year. So what we are saying that we have to take this expense every year into income statement to calculate the net income or profit. Then we're going to talk about the accumulated depreciation is the sum of all depreciation expense recorded for the depreciable asset to date. It is a contra asset. So what it is, let me explain to you. If we don't have so I am going to use this page to help you understand. Okay, so we are purchasing a computer system. All right, so today on August 1st 2023 we purchase computer system for $500,000. all right, residual value, or the value after 10 years, is going to be $0. $0. The life of this computer system is 10 years. Okay, so we calculate the depreciation expense using the formula. It will be 500,000 the cost minus the residual value of 0 divided by 10 year. It gives me $50,000 per year. All right, so we're going to create here on August 1 a journal entry: debit computer system for $500,000, and we're going to credit cash for $500,000. So what's going to happen, we have two accounts. Cash is already exists in our system. We know that there's a debit, there's a credit. Cash is down by 500,000, but it gives rise to computer system that we have purchased for $500,000. All right. Now we know that the depreciation expense is $50,000 per year. Very good. So how are we going to take into consideration? We purchased this on August 1st. Now we are on December 31st, 2023. 5 months has passed. So we can only take 5 months because this $50,000 represents the entire year. So what would be the 5 month? So the 5 month would be $50,000 multiplied by 5, and in a year how many? 12. So grab a calculator, and here is a calculator, and we type 50,000 divided by 12, so it gives us per month. We multiply this by 5, and we know that for 5 months we have used up $20,833. I just rounded it. Okay, so what we're going to say, we're going to say debit depreciation expense of 20,833, and we're going to credit accumulated depreciation of 20,830. So what is an accumulated depreciation? It is a contra account, contra asset account. So how does it work? This account usually stays right next to or right below. So I'm just using accumulated depreciation for computer system, debit and credit, and the value goes here 20,833, and you will create another T account depreciation expense, debit and credit, and you have 20,833. This account will remain with this in a balance sheet. This account, depreciation account, expense account, will go to income statement. All right, because in the income statement we report all our revenues and expense. So why it is important? Because at the end of the year, when somebody look at it, say, yes, we purchased this asset for $500,000. We have used up $20,833 worth of this computer system. So the book value of computer system is equal to historical cost minus accumulated depreciation. The historical cost is $500,000 minus 20,833. So the book value is $479,167, for example. All right. So what is the book value at the time of the purchase? It was $500,000 because there was no depreciation. A depreciation is a function of time. A time has to pass before you can claim depreciation. So you can clearly see the date of purchase is August 1st, 2023, and then you have to prepare a financial statements on December 31st, and only 5 months have passed between 2 days. So you can only claim 20,833, not the entire 50,000, because 50,000 represent the 12-month period and you have passed only 5 months. So that's how we're going to do when it comes to recording a depreciation. Okay. A contra account has two main characteristics. It is paired with and is listed immediately after a related account in the chart of accounts, and its normal balance is the opposite of the normal balance. So you can see that the normal balance here is in credit and the normal balance here for the asset is debit. Okay. Book value is depreciable asset cost minus the accumulated depreciation we just talked about. Deferred revenue occurs when a company receives cash before it does work or delivers a product. We have already discussed earlier. Okay. We talked about deferred revenue is a liability because business owes the customer the product or a service. Also called unearned revenue. We have already talked about. Accrued expenses incurred but not yet paid. We talk about accrued revenue. Expenses are incurred but not yet paid. Accrued revenue arises when a company performs a service but has not collected the cash. Okay. Delivers a product but has not yet collected the cash. Record the revenue debit to account receivable, credit to service revenue. I have already showed you debit account receivable and credit service or sales or service revenue. Okay. So what is the purpose of the adjusted trial balance and how do we prepare? Many of the transactions reflected in the accounting record, the first two steps of the accounting cycle, affect the net income of more than one period. Therefore, adjustments to the account balances are necessary at the end of each period, accounting period, whether month, quarter, or year, to record proper amount of revenue and match expenses with the revenue. So the business clearly know how much revenue I have earned and how much it cost me or an expenses. So the reason behind it, the businesses wants to be efficient. Businesses wants to be productive. Businesses do not like waste. So by measuring or matching these revenue and expense help us trim the fat or trim the expenses. The process is also intended to achieve a more accurate picture of financial position by adjusting balance sheet accounts to show unexplained cost, unexpired costs, up-to-date amounts of obligations and assets. At the end of the fiscal period, an adjusted trial balance is prepared. We talked about a list of all accounts with their adjusted balance, just like a trial balance. The difference between trial balance and adjusted trial balance is only that the adjusted trial balance have the debits and credits are equal after the adjustments, and in a trial balance all debits are not equal to, so the total of the debits are not equal to total of the credits. Okay. Then we have recording supplies, for example, supplies expense, allocating revenue received in advance, all of these examples, recording service fees earned, recording unpaid wages, all of those things we have to make an adjustment for these things. A worksheet is an internal document that helps summarize data for the preparation of the financial statement. The worksheet has 4 account names: unadjusted trial balance, adjustments, and adjusted trial balance. We have already discussed permanent and temporary accounts in the previous lecture. Let's go one more time. Permanent accounts are accounts whose balances carry over from one accounting period to the next, and they belongs to the balance sheet accounts. Okay. Temporary accounts are used to gather information for a particular accounting period and then reset to zero by transferring the balance to the permanent account. And we will show it how we close the balance income statement into a statement of retained earning, and from a statement of retained earning to the stockholders' equity. A permanent account is an account that is represented in the balance sheet. Its distinguishing feature is that any balance in the account at the end of the accounting is carried forward next. So the ending period on December 31st automatically becomes a beginning balance of the next period. Okay. A temporary account is an account used to accumulate information for a specific accounting period. At the end of the period, account balance is transferred to a permanent. We already talked about it. Temporary accounts are closed at year end. They consist principally income statement accounts, but income summary account we will talk about in the next chapter help us close these accounts. Okay, so that is today's lecture. And if you have any question or if you want me to provide more information about any of these, please let me know. And I hope to see you in the next lecture. And thank you for watching this video, and please let me know if you have any question. Thank you.